Welcome to week 4 of Finance 4443. I'm Dr. Mark Dennis, your professor and your guide for this journey through the inner workings of corporate money management. Our focus this time is all about managing short-term financing, a topic that's maybe a little less glamorous than billion-dollar buyouts, but arguably more important for keeping companies alive and afloat. Let's dive in. Think of short-term financing as the financial oxygen for any business. We're talking about managing the everyday ins and outs, paying the bills, collecting on sales, buying inventory. This is the domain of working capital management, and it's definitely a balancing act. Net working capital equals current assets minus current liabilities. And the trick? Making sure that short-term needs are always covered without overcommitting your long-term funds. So how do firms manage this balance? That's where a working capital policy comes into play. It sets the target levels for each current asset account, decides how these assets will be financed, and focuses only on current liabilities that directly support current assets, not every short-term obligation that a firm may owe. In other words, this policy keeps the day-to-day operations smooth and sustainable. Now let's talk about timing, and not just any timing. This is the cash conversion cycle, a powerful tool to understand how fast your company can turn resources into revenue. It's the time between when you pay for inventory and when you finally collect cash from sales. It involves 3 key periods: the inventory conversion period, the receivables collection period, also known as days sales outstanding, and the payables deferral period, sometimes referred to as days payable outstanding. The first piece of this puzzle is the inventory conversion period, or ICP. This measures how long it takes to turn raw materials into finished goods and then sell those goods to customers. For a service-based business, we might define this as how long it takes to convert a prospect into a customer and then make a sale. Regardless, the longer it takes, the more your cash is tied up. Shortening this period means faster turnover and improved liquidity. Next up is the receivables collection period, often called days sales outstanding, or DSO for short. This is the average number of days it takes for your customers to actually pay their invoices. Too long, and you're essentially giving away free loans. Too short, and you might strain customer relationships and damage sales. Managing days sales outstanding is a balancing act, but it's critical for sustaining cash flow. On the flip side, we have the payables deferral period, the average time a company takes to pay suppliers and creditors. This is known as days payables outstanding. Extending DPO gives you more time to hold on to your cash. But there's a fine line between smart delay and damaging your vendor relationships. A good chief financial officer knows how to walk this line with skill. Putting it all together, we see the full cash conversion cycle. The average time a company's cash is tied up in day-to-day operations. A shorter cycle means greater financial flexibility. It frees up cash, improves liquidity, and reduces the need for external financing. In finance, speed is not simply a luxury. It's an important competitive edge. You may want to pause the playback at this point and carefully study this diagram. Here's a real-world example using a company called Unilate Textiles. You'll calculate each part of the cash conversion cycle using this company's financial data, starting with the inventory conversion period, moving to days sales outstanding, and then subtracting days payables outstanding. Take your time with the math, but focus even more on understanding what it means for the firm's liquidity and financing needs. That concludes this segment of our Week 4 live chat series. See you online.